Hey folks, welcome back to the channel. The big news last week was the revised jobs number. It was a downward revision of 818,000, which is about 68,000 jobs a month, which is quite a lot. Now, with the labor market looking weaker than previously thought, you would expect the stock market to go down, as this is a negative news for the economy. But if we look at the S&P 500, the daily chart is still looking pretty strong. This was last week from Monday to Friday, up about 1.4%, and that could just be due to the momentum. Like I mentioned last week, it's likely that the market will go up and retest the previous high of 565, and we're pretty close, just 3 points away. So in my last video, I mentioned there was really no reason for market participants to be bearish. Now, the revision to the jobs number could be a red flag of what's to come, but that alone apparently wasn't enough to get investors to worry, especially when the Federal Reserve basically said they're going to cut rates in their next meeting in September. And as of right now, there's a 64% chance they'll cut by 25 basis points and 36% chance they will cut by 50 basis points. Now, we know the labor market is looking weak, not only with the revised jobs figures, but also the unemployment rate is now at a 3-year high for the US. And I've mentioned this before, but anytime where you have the unemployment rate start to go up, historically, it tends to accelerate after a certain time. And it looks like it's starting to do that right now. If we just look at this long-term unemployment rate chart here, it's more likely for this trend to continue going higher than to suddenly reverse and go back down. And the Fed sees this as well. So what has prevented them from cutting rates? Based on the labor market alone, you would expect the Fed to have cut rates already. But there's still one issue that the Fed has to worry about, which is inflation. Now, as of right now, inflation has gone down to 2.9%, and it's not likely for it to go back up, say above 4% anytime soon, because fundamentally, the global economy is slowing down and the US is also part of that. And from a technical point of view, we can see the previous support was here at 3%, bounced off that, kind of consolidated, and now it's broken through. So the previous support has been broken. The chart is currently below that, and 3% now acts as resistance. So if we see the economy continue to suffer, then the CPI could even go negative, which happened a few times in 2015 and almost happened in 2020. Just like a volatile stock, you can see the CPI doesn't like to trade flat very often. It's either going up or it's going down. If you take any 3 consecutive months, most of the time you do see some kind of trend. And as of right now, over the past 3 months, 6 months, 1 year, the CPI trend is going down. So it's very likely to reach the target of 2% over the upcoming 12 months. And if the economy starts to spiral downward more quickly, then there is a risk of the inflation rate dropping to 0 or even going negative next year. And if that happens, then I would expect massive rate cuts, not only in the US, but across the world. And that's not going to bode well for stocks, which might be why some of the richest people in the world are starting to sell their stocks and go into cash, like Buffett dumping more than half of his Apple shares. And Jeff Bezos made a disclosure to regulators that he's going to sell $5 billion in Amazon shares soon. And usually when these large investors are selling into the market, we tend to see some kind of topping process. Whether it's short-term or long-term, it's hard to say. But I do feel like the market is going to continue being volatile in the upcoming month, especially when September tends to be one of the worst performing months with an average negative return. So in terms of where the market could go in the next couple of weeks, like I mentioned last video, I expect the market to go up just a little bit more, at least hitting 565. But then I do expect a correction because this current bull channel going upward is not sustainable. And there does seem to be more bad news coming out recently than good news. And yet the market is still pushing up higher. So I would see how the market interacts with this zone over here. If it continues to push higher to all-time highs, then I would look for a back test to the 565 support area because it could be a false breakout, which will lead to some kind of correction. Or if it bounces off of here and continues going upwards, then I would continue to stay bullish, just like in the previous couple of weeks. But I think there has to be some pretty good news for the market to do that. Nvidia is coming out with earnings next week on Wednesday after the market closes. And so far, it has hit some kind of resistance here and not gone higher than this black line. Depending on how earnings go, we could see Nvidia go higher. And I think in order for the S&P 500 to sustainably make higher highs, Nvidia has to follow just because it's such a big component of the index. So basically, if Nvidia fails to make a new high, and especially if it dumps in the weeks to come, then it's very unlikely for the stock market as a whole to make a new high. So even though the S&P 500 looks like it's very close to breaking out again, it could just be a double top, sending the market lower if Nvidia doesn't continue to perform well. In the meantime, looking at the SPY again, short term, this large red bar on Thursday should act as a trading range for this current week, meaning we'll likely get some chop between a high of 563 and a low of 555 because Friday was an inside candle. But once it breaks out of this range, that is likely going to be the direction the market will go. So if it closes above 563, we'll likely see the market go to 565. And if it falls below 555, again, in the short term, we're going to look at lower targets. So that's it for now. Thanks a lot for watching, and until next time.